Hey, Abby, it's good to see you. Today we have a really important topic. We're talking about how geopolitical events affect the markets. Of course, we're talking about the tension with Russia right now. US equity markets are lower as investors try to determine what impact Russia's latest moves will have on the global economy. Investors are pulling money out of stocks and into traditional safe havens like gold and bonds. And I found this graph of asset classes year to date. I think it tells a really interesting story. Oil at the top of the list. That's not a big surprise. What else stands out to you?
I think the thing that stands out to us the most is that if you'll look at this chart here on the bottom, bonds and stocks both have a decline.
Right.
So that doesn't happen very often. It did during the 2020, the knee-jerk reaction to what was happening with the pandemic. It
Mhm.
happened in 2007 and 2008 when we had the systemic risk is what it's called there. But what a traditionally diversified portfolio would do is have, stocks and bonds, and they were supposed to be inversely correlated. So when one goes up, the other one might go down or maybe stay steady, and then vice versa. But what's happening right now, and has happened a couple of times in the past, is that both of those are falling. So
Mhm.
we've had the highest drawdown in what's known as a balanced portfolio that we've had in a while, and so
Yeah.
it's concerning to people. So that's something that definitely sticks out.
Right, because bonds we equate that with security, right? So what are you offering as bond alternatives then for people who want a little bit more security?
Right. So also bonds are under pressure right now because of the potential rising interest rates. So we've got
Right.
kind of things coming in at all angles, and it seems like a lot, I'm sure. So bond alternatives is a great point there. So one thing that we like to utilize for our clients is structured notes, and so it affords us the opportunity to take advantage of volatility. So to take
Mhm.
advantage of something like, when something like this happens, volatility spikes, the VIX spikes, and then we're able to actually get that interest rate much higher on the structured notes and provide a little bit of partial principal protection there as well. There are
Yeah.
opportunities out there. You don't have to stick with just the regular 60-40 portfolio that we used to rely so much on. There's different things out there, and there are opportunities when volatility does spike like this.
Right. Yeah. Thank you for bringing that up. And I think it's also important to remember for everybody watching that you have a team of investing experts behind you during moments like these and all the time. But we actually spoke with Brookstone CIO Mark Diorio, and he took the time to calculate other geopolitical events. Take a look at this table because, Abby, I know that you've studied this as well. What he found was that the average 1 day decline is negative 1.14%, with a total event driven drawdown of negative 4.39% over 16 days, and then recovering in an average of 35 days. I think a lot of people would be surprised to see how quick that recovery happens.
Absolutely. And when you see the headlines that we've seen just in this year alone, but if you think about the last 2 years, the headlines that me personally, I'm being bombarded with every day on my cell phone, it pops up, and it just seems like it's been crisis after crisis. And that can be really, really concerning to us just in general, but also to investors, especially those that are nearing or in retirement. It takes on a whole nother meaning. So what we think is really important to do, and we're so grateful for the team at Brookstone and Mark Diorio, of really allowing us to help our clients zoom out and look
Mhm.
at things in kind of a more bird's eye view instead of just focusing on what's going on that day and having a knee-jerk reaction, because that's when we can get into some trouble. So
Mhm.
when we look at statistics like that, we can say, all right, we've been through things like this before, not necessarily exactly the same, but similar type events. And
Mhm.
so what happened back then, and what precedent did that set, and how might the markets react? And the same thing happened back when the pandemic hit, and we went on lockdown. We looked
Right.
at previous times when nothing to that extent, but similar type events, and it did kind of follow a pattern. So
Right.
it's really helpful to take a step back and look at, all right, we've been through things before, and we're going to be okay, as a country, and things will go back to normal as far as the markets go in a
Right.
relatively short period of time. Just over a month. There's the
Right.
stat.
Yeah. And I think the other half of why that's so important is if you are invested emotionally, if you start to get scared of what the markets are doing and you pull your money out, then you are often missing out on the best days because they're smushed right up against those bad days, right? And this is looking at just 15 years. I'm sorry, 15 years and just 10 days. Look how much that money can change.
Right. So this is a great lesson here. So if you stayed fully invested in this time period, so 2006 to 2021, you end up with $45,682. If you miss just the 10 best days, you have half of that, less than
Right.
half of that, 20,929. So it's so important to have a plan that you're able to emotionally stick to, and make sure that your portfolio is built for times like these, because as we just saw in that chart, they've happened before. They will continue to happen. We have no idea what's going to happen the rest of the year. We just know that we don't know what's going to happen. So
Right.
we want to make sure that we have a broadly diversified, risk appropriate strategy that can, withstand things like this that are going to continue to happen.
hmm And Abby, we were talking before because I know that at Read Financial, you prioritize really, having a holistic plan for your clients. And so a red flag may be if I'm concerned about what the market's doing, perhaps I'm not invested the way I should be, right? I shouldn't look at my portfolio and be freaking out. Or if I am, I should be giving you a call.
Right. So that's the risk tolerance piece of
hmm
building a successful retirement plan. So, when you go into how should I be invested? Where should my money be? Risk tolerance and risk capacity should be at the forefront of that conversation. So,
Right.
how much risk can I handle? So, how much volatility can I handle before doing something that is probably going to negatively affect me in the long run, like pulling out at the wrong time, and then also how much risk do you need to take on to accomplish your goals and what you're trying to do in your life and in retirement. And that's really where the planning aspects comes in. So if you
hmm
know that, even though there's a little bit of volatility, your income plan is still sound, your investment plan is still sound, that's the peace of mind that is crucial in times like these, knowing that, it might be a little bit, uncomfortable with what's happening, but you know that you're going to get through it and you're still going to be able to reach your goals. And that's really the name of the game. We want to take that
Right.
anxiety off of people, delegate that to us because we can handle it.
Yeah, it's true. I always appreciate, Abby, that you are one phone call away. And speaking of, if somebody does want to talk this through, what's the best way to reach you?
Sure. So yeah, absolutely. Give us a call, 678-442-0255. You can also visit our website at theretirementfamily.com, or also send us an email, abby@readfinancialgroup.net, and we'll try and help out in whatever way we can.
Yeah, perfect. Abby, thank you.
Thank you, Erin.